Larry, the question that's burning at me now, of course, was the 2% in the 10-year yield, the bottom that came right before Powell kind of confirmed their next steps.
Great question. I think that's the million-dollar question. I think the market has moved past the fact that they're going to cut. We know they're going to cut. Is it going to be 1, 2, 3? That said, is there going to be a reflationary impulse into the long end of the curve? Right now, I'm thinking that the 10-year has some room, the yields to go a little bit higher. Overall, I think we're going to continue to see steepening of the 210, but the 10 really is up to data. It's up to a lot of different things.
Yeah, and today we heard more commentary from Powell, who outlined further some of the reasoning, right? Global growth seeping into some of the slowness here. We've also heard from Evans that was basically, look, we can just keep targeting inflation as high as we want until we hit it.
Yeah, exactly. And one takeaway I had was when Powell mentioned, short rates and the break-even is going to be a lot lower for a lot longer. It made me think that we have a 10-year tip supply coming up in the next 2 days, and locking in 30 basis points over value for that, to me, is a pretty reasonable value if indeed what Powell said is correct, and that we're going to be lower for longer.
Yeah. Now, is, Larry, the incremental information from here, does it need to be even more dovish for bonds to rally? I mean, to kind of ask the same, the first question a different way, what will you be looking for as a trader to see if our direction turns southward for yield again? Because it seems like coming into the latest language from Powell, right? Stocks are rallying, bonds are rallying. Stocks continue to sit at the highs, but bonds now show some hint of possible change of direction.
I used to think that too, and maybe you're right. I don't know if they're changing direction. I just think, the rally tends hitting, 194 at the low, perhaps was a little bit overdone. We all know that markets tend to, overbought, oversold, and I think right now it's just a consolidation phase, summer doldrums, et cetera. But I really do, the more I look at it, I really think sub 2% at this point was overdone.
Yeah. All right. Last thing, Larry, because you talk about the steepening of the yield curve. Tell me what you're looking at right now as the most reasonable trade to handle this situation. I mean, do you bet on a range for the bonds now?
Well, yeah. I mean, I do think we're going to have at least 2 cuts, right? And you look at the October Fed Fund futures pricing in 47.5 basis points. So that would mean a cut in July and a cut in September. I think that's true, and if that's true, I think it will provide a little bit of a reflationary impulse to the long end, but it'll give the twos a lot of room to rally. So I do think we'll continue to see steepening. The issue is that it gets expensive to have that trade on. That's 4 basis points of carry per month. So perhaps you can do it through an ETF or something like that. But doing it through the futures market or the forward market gets pretty expensive, or time's just not your friend.